Some people grind for years to build wealth only to stall outright when they're closer to success than ever before. Not because they stop earning, not because the market turns against them, but because they hit a psychological shift they never saw coming. A shift that changes how they think, how they spend, how they invest without them even noticing. And that shift happens at $250,000. A milestone that feels like progress but acts like a trap for anyone who doesn't understand what really happens next. My name is Nick, and I spend way too much time analyzing why some people become millionaires while others with similar incomes never seem to break free from financial mediocrity. Today we're diving into what I call the $250,000 rule. And I guarantee some of what I'm about to tell you will completely change how you think about building wealth. Most people believe wealth building is linear. You save 10,000, you're 10,000 richer. Save 50,000, you're 50,000 richer. Simple math, right? But here's what nobody talks about. There are specific dollar amounts where everything changes, where the psychology of money shifts so dramatically that your entire relationship with wealth gets turned upside down. $250,000 is one of those amounts, and it might be the most dangerous one. Before we dive into why this number is so critical, let me share something that might surprise you. According to recent data, the average American will earn over $2 million during their working lifetime. $2 million. Yet somehow most people retire with less than $100,000 in savings. Where does all that money go? It's not just about spending habits or market crashes. It's about psychological traps that kick in at specific wealth levels. And the biggest trap of all happens right around $250,000. Here's the thing about reaching $250,000 in investments. It's the moment wealth stops feeling theoretical and starts feeling real. This is when your money begins moving faster than you do. One good market a day can earn you more than your entire weekly paycheck. One exceptional month can generate more passive income than some people make working full-time. But here's where it gets dangerous. It's also the point where one wrong decision can erase years of careful progress. Think about it this way. When you have $5,000 invested, a 10% loss means you lose $500. Painful, sure, but not life-changing. When you have $250,000 invested, that same 10% loss costs you $25,000. That's more than the median American's entire annual savings. Suddenly, the stakes aren't just higher. They're in a completely different universe. But the real danger of hitting $250,000 isn't the potential losses. It's something far more subtle and infinitely more destructive. It's what happens inside your head. See, there's this fascinating psychological phenomenon that kicks in around this wealth level. I call it the illusion of arrival. You start seeing your portfolio jump $5,000 in a single day. And suddenly, your brain starts playing tricks on you. You begin thinking you've made it. You start feeling wealthy. And that feeling, that dangerous, intoxicating feeling, is where most people's wealth building journey comes to a screeching halt. Let me paint you a picture of what this looks like in real life. You check your investment account on a Tuesday morning and boom, you're up $8,000 from the day before. Your brain immediately starts calculating $8,000 in one day. That's more than you used to make in a month at your first job. Clearly, you're doing something right. Clearly, you deserve to celebrate. Maybe it's time for that vacation you've been putting off. Maybe you should finally upgrade your car. After all, you're practically rich now, right? Wrong. It's dead wrong. And this is where the $250,000 rule becomes absolutely ruthless. Here's what's actually happening at $250,000 that most people don't realize. You're not rich. You're not even close to rich. What you are is dangerous. Dangerous to yourself, dangerous to your future, and dangerous to the wealth you've worked so hard to build. You have just enough money to make really expensive mistakes, but not enough money to recover from them quickly. That $8,000 gain I mentioned, it's unrealized. It exists only on paper, only in the digital realm of your brokerage account. It can disappear tomorrow, next week, or next month just as quickly as it appeared. But that $10,000 vacation you're considering, that's very real, very permanent, and very capable of setting your wealth building journey back by months or even years. This is what I call the dangerous illusion that appears at $250,000. The illusion of wealth before you're actually wealthy. And it destroys more financial futures than market crashes, economic recessions, and bad investment advice combined. But wait, it gets worse. It's like the psychological traps don't stop at feeling wealthy before you are wealthy. There's another monster lurking at the $250,000 mark. And this one is even more destructive. I call it the overconfidence monster. And it feeds on something psychologists refer to as the Dunning-Kruger effect. Here's how it works. You've managed to accumulate a $4 million through some combination of saving, investing, and maybe a little market luck. Your portfolio has grown steadily for several years. You've weathered a few market downturns and come out ahead. You start thinking you understand how this whole wealth building thing works. You start believing you're some kind of investing genius. This is when people go completely off the rails. This is when conservative index fund investors suddenly think they can pick individual stocks. This is when people start dabbling in options trading, chasing meme stocks, or throwing money at speculative real estate deals. This is when the phrase, "I can afford to lose this," becomes the most expensive sentence in the English language. The cruel irony is that at $250,000, you finally have enough money to make the kind of mistakes that can set you back years. You can afford to lose $10,000 on a bad stock pick. You can afford to gamble $20,000 on cryptocurrency. You can afford to invest $50,000 in your buddy's restaurant venture. The problem is that affording to lose money and being able to afford losing money are two completely different things. One bad decision at this wealth level can delete 2 to 5 years of compounding growth. Think about that for a moment. 5 years of disciplined saving, 5 years of consistent investing, 5 years of delayed gratification, all wiped out because you thought you were smarter than the market. And here's the kicker. The bigger your account gets, the more confident you become and the bigger the mistakes you're willing to make. It's like psychological quicksand. The more you struggle, the deeper you sink. But there's yet another trap waiting at $250,000. And this one might be the quietest killer of all. It's what I call the comparison trap. And it works like this. You finally reach $250,000 in investments and for a brief moment you feel successful. You feel accomplished. You look around at your peers who are still living paycheck to paycheck and you feel pretty good about your financial situation. Then something happens that changes everything. You meet someone at a networking event who mentions they have $500,000 invested. Suddenly, your $250,000 doesn't feel so impressive anymore. Then you read an article about someone your age who's already hit $800,000. Now you feel behind. Then you stumble across a social media post from someone flaunting their $2 million portfolio and suddenly you feel like a complete failure. This is where people sabotage their own progress trying to catch up. They abandon their conservative steady approach and start chasing higher returns. They increase their risk tolerance beyond rational limits. They start making desperate moves to close the gap between where they are and where they think they should be. Where the comparison trap is particularly vicious because it's never ending. There will always be someone with more money than you. Always. Even billionaires compare themselves to other billionaires. The moment you start measuring your success against someone else's highlight reel is the moment you stop appreciating how far you've actually come. But here's what makes the comparison trap so insidious at $250,000. It's not just about feeling bad about your progress. It's about the specific financial behaviors it triggers at this exact wealth level. When you have $50,000 invested, comparing yourself to someone with $1 million doesn't really change your strategy. You're still focused on the basics, still saving what you can, still learning the fundamentals. But at 250,000, that's when you have just enough money to make really stupid decisions in the name of catching up. This is when people start leveraging their portfolios. This is when they take out home equity loans to invest in the stock market. This is when they convince themselves that taking on debt to invest is just being strategic. After all, if the market returns 10% and you can borrow at 6%, that's free money, right? Wrong. That's how you turn a temporary setback into a permanent catastrophe. I've seen people with solid $250,000 portfolios completely destroy themselves trying to accelerate their timeline. They'll see someone bragging about making 6 figures in cryptocurrency and decide they need to allocate $50,000 to digital assets. They'll hear about someone doubling their money in real estate and suddenly think they need to become landlords. They'll read about day traders making thousands per week and decide their boring index funds aren't cutting it anymore. The brutal truth is that at $250,000, you're at the most dangerous point in your entire wealth building journey. You have enough money to hurt yourself, but not enough to protect yourself from your own bad decisions. But let's talk about something that might surprise you. Something that financial advisors and wealth building gurus rarely mention because it doesn't sell courses or generate fees. The real secret about hitting $250,000 isn't about what you should start doing differently. It's about what you should absolutely not do. Here's the thing. Nobody tells you about crossing the $250,000 threshold. You don't need to get fancy. You don't need to start picking individual stocks. You don't need to diversify into real estate investment trusts or commodity funds or international emerging markets. You don't need to hire a financial advisor who's going to charge you 1% annually to tell you to do exactly what you were already doing. What you need is something that sounds almost boring. You need to keep doing exactly what got you to $250,000 in the first place. But here's why that's so hard. Continuing to do the same boring thing when your account balance is jumping around by thousands of dollars every day feels like you're not maximizing your potential. It feels like you're leaving money on the table. Your brain starts playing this cruel game where it shows you all the opportunities you're supposedly missing. Look at that stock that went up 300% last year. Look at that real estate deal that would have doubled your money. Look at that cryptocurrency that made people millionaires overnight. Surely with your $250,000 foundation, you can afford to take some of those risks. Now this is the exact moment where discipline becomes more valuable than intelligence. This is where the ability to ignore noise becomes more important than the ability to analyze opportunities. This is where boring becomes beautiful. Because here's what actually happens. When you stay boring at $250,000, something magical occurs that most people never get to experience because they sabotage themselves. First, your money starts working harder than you do. Let me show you some math that will completely change how you think about this milestone. If you have $250,000 invested, earning 8% annually, that's $20,000 in growth per year. $20,000. That's more than some people save in their entire lifetime. And your money is generating that much every single year without you lifting a finger. But it gets better. Because of compound interest, that $20,000 in growth starts earning its own returns. Next year, you're not just earning 8% on $250,000. You're earning 8% on $270,000. The year after that, 8% on over $290,000. The growth starts snowballing in ways that will genuinely shock you if you've never seen it happen before. Here's the part that will blow your mind. From $250,000 to $500,000 takes about half the same amount of time as it took you to get from 0 to $250,000. Read that again. The second $250,000 comes twice as fast as the first and the $250,000 after that even faster. This is why I call $250,000 the point of no return. Not because you can't lose money from here, but because if you can resist the psychological traps at this level, building serious wealth becomes almost inevitable. Your money develops momentum that becomes increasingly difficult to stop. But there's something else that happens at $250,000 that nobody talks about. Something that has nothing to do with compound interest or market returns. You gain something that money can't directly buy, but wealth can definitely provide. You gain options. When you have $250,000 invested, you're no longer trapped by your paycheck in the same way most people are. You can't retire on it, obviously, but you can make career moves that people living paycheck to paycheck simply cannot consider. You can take a temporary pay cut to join a startup with equity upside. You can negotiate more aggressively with your current employer because walking away isn't financial suicide. You can relocate for better opportunities without worrying about covering moving expenses. This is what I call the hidden power of 250,000. It's not just about the money itself. It's about the freedom that money provides to make decisions based on opportunity rather than desperation. And these decisions, these career moves and calculated risks that become possible at this wealth level often accelerate your income growth far beyond what your investments alone could achieve. Think about this for a second. You've spent years building discipline, learning to live below your means, and consistently investing. You've developed what most people never develop, the ability to delay gratification. But now, ironically, that discipline becomes harder to maintain when the rewards get bigger. It's like learning to drive in a Honda Civic and then being handed the keys to a Ferrari. Same basic skills, completely different stakes. This is why so many people stumble right at the $250,000 mark. They mistake having options for having unlimited options. They confuse being strategic with being reckless. They think because they can afford to lose $10,000, they should be willing to risk it. But here's the brutal truth about this wealth level. Every dollar you lose now costs you roughly $4 in future wealth due to compound interest. That $10,000 mistake today becomes a $40,000 mistake 20 years from now. Let me share something that might sound counterintuitive. The secret to navigating the $250,000 threshold isn't learning new strategies. It's unlearning the need to be clever. The biggest winners at this level are often the most boring people you'd never want to sit next to at a dinner party. They keep buying the same index funds, keep living in the same reasonable house, keep driving the same reliable car, and keep doing the same boring things that got them here in the first place. But staying boring requires something that's surprisingly difficult. When your net worth is jumping around by thousands of dollars every month, it requires ignoring the voice in your head that says you're not maximizing your potential. It requires accepting that slow and steady really does win the race, even when the race feels like it should be more exciting by now. Here's where the math gets really interesting, and this is something that will fundamentally change how you think about the $250,000 milestone. Most people think of 250,000 as being 1/4 of the way to $1 million. But compound interest doesn't work like that. In terms of time, 250,000 is actually halfway to becoming a millionaire. Let me break this down because the numbers are genuinely mind-blowing. If you're consistently investing $10,000 per year at 8% returns, it takes about 13.8 years to reach your first $250,000. But here's the kicker. It takes roughly the same amount of time, another 13.8 years to go from $250,000 to $1 million. The same amount of time for 3 times as much money. This is the moment compound interest stops whispering and starts shouting. Your money has finally built enough momentum to roll downhill without you constantly pushing the boulder uphill. This is why Charlie Muir famously said the first 100,000 is the hardest. But the principle applies even more dramatically at 250,000. But knowing this creates its own psychological trap. When you realize you're halfway to millionaire status, it can trigger what I call acceleration anxiety. You start thinking there must be something you can do to speed up the process. Maybe you should increase your risk tolerance. Maybe you should start picking individual stocks. Maybe you should leverage your portfolio with some borrowed money to really supercharge your returns. This is exactly backwards thinking. At 250,000, your job isn't to accelerate the process. Your job is to not screw it up. Your money has reached escape velocity. It's generating its own momentum. The worst thing you can do is interfere with that momentum by getting creative. I want to share something that most financial advisors won't tell you because it doesn't sell their services. The difference between people who build lasting wealth and those who sabotage themselves at this level often comes down to three simple rules. Not complicated strategies, not sophisticated tactics, not insider knowledge. Three boring, unglamorous rules that separate millionaires from everyone else. So, there you have it. The $250,000 rule isn't about what you should do when you hit this milestone. It's about what you absolutely shouldn't do. Stay boring, stay disciplined, and let compound interest do what it does best. Because the hardest part wasn't getting to 250,000. The hardest part is not destroying it on your way to becoming a millionaire.